We have the session Revolutionizing Fraud Prevention, Harnessing AI and ML to Safeguard Banking from Fraud, being presented by Angela Zhou, who is the Director of Risk Control and Fraud Analytics at CIBC, along with Kemi Borisade, who is a Senior Fraud Data Analyst CIBC. Angela Hu brings over 15 years of strategic data analytics experience in premier financial institutions. As a seasoned technical expert and strategic thinker, Angela has demonstrated success in developing and implementing innovative strategies. Passionate about leveraging cutting-edge technologies to solve complex problems, Angela is dedicated to applying the latest advancements in ML and data analytics to add value to her company and enhance the experiences of the client. Please welcome Angela Hu. Kemi Borisade, a data professional with expertise in data manipulation, visualization, and ML libraries. She is good in extracting valuable insights from complex data, automating processes to deliver insightful reports, and ultimately enhancing business decision-making. A B.Eng in computer hardware and software engineering, and an MS in robotics and autonomous systems. She's currently a senior fraud data analyst and utilizes her skills in extracting and analyzing data, as well as building ML models to detect high-risk fraudulent applications. Kindly join me in welcoming both of them. Thank you.
I'll speak here. Hello, can you hear me okay? Good. Thank you all for attending our session today. That means you care about fraud or CIBC or us, anyway. And for today's session, we will talk about how to leverage artificial intelligence and machine learning to safeguard the bank. Before I get started, I want to ask some questions. Raise your hand. Have you ever received any phishing emails? It may say, congratulations, you own a big prize. We just need your bank account information, then we can deposit money to you. Or have you ever received any smishing message? It says, urgent, your bank account is locked. We just need some personal information to unlock your account. Or have you ever received any phishing phone calls? The caller on the other side, they even know your name, and they claim they are from the IT service. They just need your password to log into your computer and help you solve your issues. Personally, I experienced all those three. So as you can see, fraud really evolved through the years, from maybe telemarketing, mail scams, to social media or artificial intelligence-based scams. As the scammers become more and more sophisticated, we also have to learn the latest trend, try to evolve our toolbox. That's why today we want first raise the awareness of fraud for the public, and then second, share some of the knowledge we are having now, like a self-learning model we built to identify fraud. Okay, so today's agenda, first we will talk about the different categories of fraud in the banking environment. And then we will share some tools and methodologies we are using currently and our future strategies. Of course, the key part is the solution, a self-learning fraud model, which is cloud-based and AI embedded, which is quite innovative way to identify fraud in the banking industry. And last, we will share some emerging fraud risks and some takeaways. Hope after this session, our immune system to fraud can be stronger. On this page, you can see three significant numbers. First, 567 million. That's the reported fraud loss in Canada in 2023, based on the Canadian Anti-Fraud Center. And one thing to remember is that the fraud reported rate is still very low, about 5 to 10%. Which means the actual fraud loss can be much higher. 10 billion. This is the fraud loss based on the US Federal Trade Commission. That's the total reported loss in US last year. To put this in perspective, 10 billion, that exceeds the GDP of some small countries. And the last one, 486 billion. This is based on NASDAQ's Global Financial Crime Report. That's the total loss last year. When we look at all those big numbers, one question we ask, how can we help? How can we protect ourselves? So first, I think we should first commit not to engage in any fraudulent activities ourselves. Then, if you find something is too good to be true, or there's an urgency related to it, try stop and think through it. Or ask your trusted friend or family members. Create a very healthy financial support system. And once if the fraud really occurred, do report that to your local police or financial institutions, or just call the number, Canadian Anti-Fraud Center there. By reporting that, there's no shame to talk about fraud publicly to raise awareness. Together, we can fight it more effectively. In the banking environment, when we talk about fraud, we separate by first, second, and third party. For the first party fraud, which refers to the fraud committed to the bank by its own client. So the client can provide falsified documentation to apply for some financial product for monetary gain. Some examples can be a client obtained a car loan, then purchases a high-end vehicle, then just leaves the country and without making any payment. Some other cases, a client may apply for a loan, but they said they are working in a non-existing company. So in this case, we'll try to find those person. And there's another case, some clients, they may repeatedly deposit and withdraw same amount of money. Make an illusion, it's like they have some income, but in fact, it's the same amount of money there. We call it like a staged payroll. So here are some examples about first-party fraud. To the right side, for the third-party fraud, it's the other side. The fraud was committed by some third party, not related to any banking client. And one of the examples I mentioned earlier, the phishing emails, or like a smishing message, or phishing phone calls. If the scammers successfully got your information, they can use that to take over your account, or they can use the person's information to apply for some lending products without the consent from the person. Another trend, they call it synthetic identity fraud. In this case, the fraudster can leverage some true information and some fake information, combine them together to make a synthetic ID. For example, I can borrow one person's first name, another person's last name, and my favorite date of birth. And then I create this identity and apply for some credit products. I can use that to build the credit history. They can wait like months or years to have a good credit history. Then they will start to apply some large amount of loans or credit cards. Then they will just use all the limit and disappear. And those are the examples. Second party is in the middle between first and third. Some clients, they even allow other people to use their information to commit fraud. Those are hard to identify. For our team, we focus on the first party fraud. And now I will pass that to Kemi to talk about some more details.
So here we're going to be talking about current solutions or current situations that we're facing versus the future. So when you look at the future, some of these solutions have already been implemented. Some of them are starting to be implemented, and one of them is the self-learning model that we're going to be talking about. So let's just look at the first part, which is basically the static versus the self-learning. So traditional models. So these are like your normal models. So you have a problem, you build a model, and then these are models that, for instance, they have been in production, like they were built with historical data, they've been in production for 2 years. We don't evaluate these models, so they're using historical data, which also means that that data could become obsolete. You know, it's not able to determine like emergent fraudulent tactics, because fraud like 2 years ago is probably changed now. So using static models means that we cannot like continuously identify fraud, which raises the number of false positives. So how do we fix that? we go to create the self-learning and dynamic models, which I will be talking about in a bit. So the self-learning and dynamic models basically use like new data every time. So it's continuously improving itself, trying to get better, trying to use new data to determine what fraud is, which is better than the static model. Looking at the batch process versus the real time. So currently we have like a process where we have approved applications that are sent in a batch overnight. And out of these approved applications, there are fraud alerts that are identified. Now, he identifies the fraud alerts, and then he sends it to the fraud investigators to work on. Now, the problem with this is it's more of a reactive than a proactive process, in the sense that because you have to wait for the batch alerts, it means that sometimes when people go into, say, they go into the car dealership, because we have like this auto loan products, they go into the car dealership, they can't really get their car immediately because it still needs to be investigated by fraud investigator. How do we fix this? We fix this by doing the real time. So what is the real time? It's the more proactive process where fraud alerts are being generated in real time, so the customer does not have to wait, and it doesn't like affect the customer experience. Now we look at the manual versus the automated documentation validation. One of the ways that our investigators identify fraud is through looking at the documents. So they look for misalignments, they look for errors, miscalculations, even in like your tax documents, right? And this is a very like daunting process. It takes a while to like go through everyone's like, documentation to try and identify fraud. It takes time to review, and then also human resources as well, because it means that we need more people. So how are we fixing that? We're fixing that by using AI and OCR technologies. We want to use this to identify fraud, because with the AI and OCR technologies, you can like go through a large volume of documents at once. It also means that it sort of takes away the time that the investigator is spending trying to review and trying to look for the miscalculation. And the thing is, with the manual one, it's really prone to human errors, because at the end of the day, if the investigator is tired and they're looking through like the documents, they could make mistakes. But with the automated way, they're able to, the AI and the OCR is able to identify it better. And it also like removes the need for like human variability as well, where one person thinks, oh, this might be fraud, and another person thinks it might not be fraud. The last part is silos and collaboration. So as Angela had mentioned before, fraud is a huge thing. So it's something that cannot be, say, fixed by one team or one bank. So we're at the point where we're trying to collaborate with teams, because in a bank you have so many analytics teams, so many machine learning teams, and everyone's like trying to fight fraud. If we don't collaborate together, it's hard for us to be able to determine the best way to fight it. And even within, like that's within the bank, even outside the bank as well, we want to be able to work with like other financial institutions in order to be able to identify fraud. So here I am going to show you one of the solutions that we developed. So that's, we're looking at the static and the dynamics in self-learning. So as I said before, the static, you have a business problem. You're trying to fix it. You take your historical data and you build your model, right? After 1 to 3 years or even more, you decide to retrain or rebuild the model. That's the static way. Now we're going to talk about the dynamic or self-learning. Now you use the same format. So basically you get your historical data, you build your model, you clean your model, and you do training and validation. Now the difference with this is that we're building a new model monthly. And how are we doing that? So we're using a champion challenger framework where we start with a model, we train the model, we evaluate the model, we get the metrics and everything. That becomes our champion model. Now the next month, we build another model. Now what we do is that becomes our challenger model, right? That's the new model. So the challenger model, we take the metrics and then we compare it to our champion. If the challenger model outperforms the champion model, then we replace it. If it doesn't, we keep the champion model. So how is this helping us? This is really helping us in a way that we're getting new data every time. So as fraud like tactics are emerging, as it's changing, we're also changing as well. We're looking at new data, we're looking at fresh data. And the good thing is we don't get to change, we're not changing the model every month. We're only changing the model if the performance increase. if the, like say, the AUC increases or if the AUPRC increases, then we decide to change the model. And then of course, we would also ensure that like we are documenting as well to make sure that we're performing analysis as well, making sure that the model that we're replacing with is way better than the model that we had before. Now I'm going to be talking about the building challenges. So usually with models, there's always challenges, right? The first challenge is data cleaning. Data cleaning is like a major and a critical aspect of building a model. It takes like sometimes 50% to 85% of the time that you're actually using to build the model. Now, especially when you have data that's coming from different data sources. One of the things that we wanted to change in our model, differently from, one of the things we wanted to do was build a new model, but another thing we wanted to do was include bureau data, because we felt that bureau data helps you understand. If I'm able to understand your history, I'm able to kind of predict what your behavior would be when you come to me. So that's why we wanted to include bureau data in our model. And that meant that we had to spend some time trying to clean this because this was not included in our previous model. Another challenge that we had was limited bureau data. So recently we switched bureau providers, which meant that we couldn't go as far back as we wanted to go in terms of like getting historical data, which meant that we needed to be careful ensuring that even though we couldn't go as far back, we wanted to ensure that our model was still performing as well as it should. Feature engineering and selection. So one issue that we had was we had a lot of variables, but we did not want to use all of these variables. It was important to us to use variables that were very predictive of fraud. So how did we do this? We started off with trying to obviously convert our variables into, our categorical variables into numerical using weight of evidence. And then after that, we did some statistical analysis. So we looked at ANOVA, which is analysis of variance, and we also looked at chi-squared as well. So we first of all removed variables that were not statistically significant to the model, or that would not be useful to the model. And then after that, what we also did was hierarchical clustering. So what hierarchical clustering is basically taking your features and grouping them into clusters. Why do you do this? To reduce dimensionality. You don't want to, we don't want 100 and something variables. If those 100 and something variables are important, then we want them. But if they're not, we want to like reduce them as much as we can. So the hierarchical clustering was used to, we grouped features into different clusters, and then after grouping them into different clusters, we sort of chose representatives for each cluster, because we don't want variables that are similar, that are providing the same information to the model, because it means that like when the model starts to overfit, it would overfit with all the similar features. And then after that, what we did was we then did correlation to remove variables that were highly correlated with each other. As I said, the reason why we did this was because we wanted a more systematic approach of removing variables that we knew were not going to be significant to the model. We didn't just want to remove them based on a hunch or a feeling. We wanted a more systematic approach. Now, going to the model, when you're building a fraud model, one of the major things that you would face is imbalanced data. There's always more non-fraudulent cases than fraudulent cases, so that's always an issue. So how did we deal with overfitting? So one of the ways that we dealt with overfitting was using regularization. So we used like early stopping, ensuring that the model wasn't training for too long. Another way that we dealt with this was we used the more automated approach to determine our hyperparameters. So we didn't want to like just tune our model manually. So we used an automated approach where we defined the space to say, okay, for instance, learning rates, try learning rate from here to here with steps of this, or try gamma from here to here with steps of this. Why we wanted to do that was we wanted the model to use different numbers of combinations in order for it to be able to find the optimized set of hyperparameters for our model. And what we also did was we defined a customized loss function. And that loss function was really just penalizing the model if it overfits. And then I'm going to talk about the metrics. So one thing that we didn't want to do was use accuracy as a metrics, because when you're building like a fraud model and the data is imbalanced, accuracy is not so useful for you, because the model might decide to just predict more of non-fraudulent cases because that's the most that it has, right? So we wanted to use AUPRC, which is area under the precision recall curve, which is more sensitive to imbalanced data than, say, accuracy. We also used like the F1 score as well, which is like the harmonic mean between recall and precision, ensuring that like we're able to predict each class. So we're able to predict the minority class and we're able to predict the majority class correctly. One major metric that was important to us was fraud categories. So we group our fraud categories into like two main parts. So we have the confirmed fraud and the abandoned fraud or the possible fraud. Now the confirmed fraud is basically like the fraud alerts went out, the investigator investigated it, they saw evidence that it was definitely fraud. That's confirmed fraud. Now the abandoned fraud is basically the fraud alert went out, the investigator investigated it, they weren't really sure whether it was fraud, but they also were not comfortable enough to let the application go through. Now, what we wanted was to predict more confirmed fraud. Why? Because we don't want our investigators working on false positives. Because in that abandoned category, you could have like clients that are genuinely not committing fraud. Maybe they just had an issue with their documents, right? So we wanted to make sure that we were predicting more of the confirmed fraud category. So that was one of the metrics that we used in evaluating. If our model predicted more confirmed fraud, then we would see that model as being good. And as I said before, we're also using the champion challenger as well. So we compare the champion and the challenger on like all these different metrics and then pick the one that's performing well. Lastly is interpretability. So it was important for us to be able to like understand the model. Now, one of the ways that we already tried to like work with the features was to do feature engineering and selection, right? Now, what we did here was variable importance. We used sharp values. So sharp values basically tell you how much each variable is contributing to your model. So let's say, for instance, we look at what a typical fraud, like a typical fraudulent transaction, what variables are contributing to this? Is it like, say, for instance, you could have low income and high requested amount contributing to the sharp values of a fraudulent transaction. So we wanted to like ensure that we could explain the features, we understood the features that were being fed into this model. And then I would just speak about how this model improved being able to identify fraud. So first of all, when we started this, our older model was being built on premises. But then with the new model, what we did was we moved it into the cloud. So we were building this in Azure Databricks and using like Spark Data Frame. So the amazing part of this was that we were able to record the metrics. We were able to record how the model was performing using ML Flow, which was really good, which is what we did not have before. And then, of course, we have the monthly model refresh now, which I explained before, which is the champion versus the challenger. So every month, we have a new model that we're building, and every month, we're trying to see, do we have a better model? If we do, we replace. If we don't, we keep the existing one. And then improved fraud detection capabilities. So one thing we saw was that top 1%, now we can cover about 10% of the fraud cases, and then top 50% covers 94% of the fraud cases. One other thing that we did was to increase the detection of confirmed fraud. As I said before, we want to increase the number of confirmed fraud that we're detecting. We don't want to predict a lot of abandoned fraud, because then at the end of the day, we want to make sure that it's not like lost sales. And then also identifying new and emerging fraud patterns as tactics evolve. I mean, if you're using new data, if you're refreshing your data every time, then obviously as the fraud pattern changes, your model is also learning as well. And then that's what the last part says. It says that like the model is basically continuously learning, and then we don't need to retrain, because with a static model, we have to retrain if we want it to, start to perform better. But when with a monthly model, because we're building a new one monthly, it kind of eliminates the need for manual retraining that would have come with the other model. So I would pass it back to Angela now.
Yeah. Thank you, Kemi, for providing the information about the self-learning model. The model is learning by itself. We also have to learn ourselves to understand the latest trend of the fraud. So synthetic ID, as I mentioned earlier, it's a new trend there. Contactless fraud, this one happens like to the contactless credit card, debit card, mobile payments. Those that have the near field communication capabilities there. Pig butchering, how many of you have heard that? Okay, maybe I can give more information about this one. This is a sophisticated online scams. The scammers may first reach out to the victim through social media like Facebook, LinkedIn, or like some dating apps or other online platforms. They may spend weeks or months just build the relationship and gain the trust from the victim. And then after that, they build the trust, they will give you an opportunity about investment. Most of the time, it's the cryptocurrency involved there. And initially, the victim can invest small amount of money, but quickly, they can see a big return there. And even they can get the money out at that stage. They call it fattening up the victim, also the pig there. But when the victim really invests a lot of money in it, the scammer will just disappear with all the money. So they call it pig butchering. It's a new trend there. And another one is like an AI-based deep fake. It's like a leverage deep learning methodology. And they can create the content looks like a real, but in fact, it's a fake one. You may get a video phone call from your company's CEO, ask you to transfer some money immediately. But in fact, yeah, I know it's hard to say no, but double check from different resources. And you may heard of IT as a service or software as a service. Since fraud becomes more and more, seems like an industry. They have their own terminology. They call it fraud as a service. And for us, as I mentioned, it's very important to raise the awareness. And if you know any fraud, remember to report it. And also for CIBC, we have some links there to help you provide some tips to identify the scams. As we conclude our session today, every information we shared, I hope it can equip us to be more vigilant and proactive. Remember, the solution, I think every one of us holds a piece of that solution. And the real power lies within us. So let's stay vigilant, stay united. Together, we can create a much secure and transparent world. Thank you all for your participation.
Any questions?
Yeah, any questions? Yeah.
Angela and Kemi, we have mic runners. Cecilia will be able to bring in the mics, so we have some questions in the front. Thank you.
Hi. So I understand working in a banking environment, there are limitations with the kind of models that we can use sometimes. So I understand that you use sharp values for interpretability, but was there any limitations on the kind of models you guys were able to use? And was that kind of factored in? Yeah.
So I wouldn't say that there was limitations as such on the kind of models that we could use. We currently use an XGBoost model, but we didn't start off with that. We started off with the simple models like random forest, logistic regression, and the likes, and then we then ended up with XGBoost. And the reason why we wanted to use XGBoost was basically because we were moving it into the cloud, and XGBoost worked better with the cloud infrastructure. So no, we did not have any restrictions as to the model. Yes.
Just to follow the previous question, can you elaborate on the importance of features, which is useful for your first-party fraud?
Okay. Sorry, so importance of features, you said. So yes, this is called shapely additive importance, right? And what it does is basically takes your model, so you see your model, and then it gives you, it's the same way you do feature importance, right? When you build a model, you look at feature importance and you see what features are very important to the model. Or what kind of features were important? Is that what you're asking? So one of the features that was important was client score. So we have another model that feeds into this model. So what that model does is it rates each client according to their level of fraud. So that was very important. Another one that was very important was requested amount, and then occupation and even income as well, because sometimes people sort of like inflate their income, right? To make it look as if they want to, like, they have a lot of money. And then sometimes they also forget to do that. So what our investigators also look at is, okay, you're trying to request for this money. This is how much you're earning. Does it make sense? So those are some of the features. Did I answer your question? Yeah. Okay.
So
We have just one more question.
Can I ask one more question? Yeah, there's a subcategory in first-party fraud. Is the friendly fraud. It's like myself make the purchase, but I forgot about it. Would your algorithm be able to detect that?
Sorry, say that again.
There's one subcategory in the first-party fraud. It's called friendly fraud. A friendly fraud is myself make a purchase,
Yeah.
but I forgot about the purchase myself. So I call the bank and say my card has been stolen.
Yeah.
For that type of subcategory, is your model be able to?
So one thing
look at
that I should have mentioned in the beginning was, so we focus on first-party fraud, yeah, first of all, and then also this model was built for mortgage to start off. Yeah, so it's a mortgage model. We're going to build it for other models as well, but we started off with a mortgage model. So, yeah. Okay. I guess if anyone has any questions, we'll just be like outside, just, yeah.
Thank you. Thank you so much.